there, welcome to SSP live stream. I'm your host Jaden Sterling. Today is Monday, January 13th, 2025. Can you believe it? It's even weird to say mid-January 2025. Whew, how time is flying by. All right, lots to cover with you today. By the way, I hope you had a great weekend and hope everything is good in your life because wow, there is so much going on in this world. And you know what? I think we need to take a moment to pause here and give gratitude. If you have a roof over your head, food in the refrigerator, things are good in your life, your family's healthy and well, and you don't have any worries, good on you. That's awesome. There are so many people right now who are displaced, just having a very difficult time, not sure what to do. And, I just think as a community, I think it would be awesome to reach out, find someone. I'm always a believer in giving to those that we know rather than the big, charities and things like that, Red Cross. So much is lost in the management of those big institutions, and so few resources flow to the people in need. So yeah, I'm just a big believer in giving directly to those who are impacted. Maybe you have friends or family who are, and gosh, if there's anything that we can do to help make life easier, probably would be certainly appreciated. All right. Wow, what a market. In 1 week, we've had a tremendous sell-off here in the NASDAQ. The Dow seems to be holding up really well today, up less than 1%. NASDAQ down 75 basis points, less than 1%. We've got silver and gold down. We've got the cryptocurrencies off today. TSX markets, just a lot of selling pressure in this market. So I want to talk about a couple things that are really pivotal this week in the marketplace. One is, it always goes back to earnings. This Wednesday, we're going to see the banks, JP Morgan, Citi, BlackRock, Wells Fargo, Goldman Sachs, Synovus, like all the big banks are reporting on Wednesday. And I think that we need to really be mindful and take a look at, what we could potentially see with these banks. Have a listen. I came across this video. I thought it was excellent.
Big banks officially kicking off earnings season this week. Citi, JP Morgan, Goldman Sachs, Wells Fargo, just some of the names set to report. Those four reporting on Wednesday. Bank of America, Morgan Stanley, they're set to report on Thursday. We want to bring in Gerard Cassidy. He's RBC Capital Markets analyst. Gerard, when it comes to some of the themes that we're unpacking this week, I think the big question right now with the rates discussion where it is about whether or not banks are going to live up to that high optimism. What do you think?
It's going to be very interesting because certainly the fourth quarter results are expected to be good. You're going to see stronger investment banking activity. Credit quality is expected to remain very healthy. And we think that we'll start to hear about some improvements in the net interest margin. What's interesting is what the outlook's going to be for 2025. That's what investors are likely to focus in on. Many of the banks will give us 25 guidance, particularly for their revenue line known as net interest revenue. And the net interest revenue line is impacted by obviously earning asset growth, particularly loans, but also the net interest margin. And when you take a look at where rates are today and the expectation now that the Fed funds rate may not drop much more from where it is today, we currently have a positive sloped yield curve.
So I want to stop him there. That is the case, y'all. Like positive slope, it means that short-term rates are lower than long-term rates, and it hasn't been that way for quite some time. We've had this inverted negative yield slope curve where short-term rates were higher than long-term rates, and that is never healthy for a market. So he's got a really good point here. Let's keep listening.
We haven't seen that since 2022. This is very positive for net interest revenue growth. Would also suggest that if the U.S. economy is going to grow 2 to 2.5% in 2025, which it appears likely at this time, and you put on 3% inflation, that's nominal growth of over 5%. And we think that loan growth has been held back over the past 2 years due to some uncertainty on the regulatory front regarding capital levels. We think loan growth could really be the upside surprise in 2025, leading to better than expected earnings for the banks in 2025.
Gerard, I wonder, as you're mentioning.
So there you go. Very, very interesting. And yeah, we need to see this consistent earnings growth. Now, analysts have these earnings numbers set at a pretty high bar with some of these bank stocks. So that's why I say it's pivotal this week in terms of where their earnings come in. If they don't reach earnings or they fall short, there could be an issue with that going forward. I want to show you a couple things that I think are well worth noting at this point. And that is, so what you're seeing here is the delinquency, hard to say that 10 times fast, delinquency rate on credit card loans, banks not among the 100 largest in size by assets. So that is approaching 8%. So what that means is it's a look at the, your local banks, your credit unions, your savings, local savings banks, and that has always been the tricky part of this economy is what is going to happen to the local banks. Because if you look at the difference, I want to show you the difference here because there's kind of this cherry picking of data, economic data going on here that is actually impacting the narrative of what's being reported. Because if you look at this is the delinquency rate on consumer loans, all commercial banks. So as you can see, it's right at that 2.5% mark. And that is what is being quoted in the news. It's like, yay, look, delinquency rates are low. People are able to pay their bills. But when we look at this other source of, let me go back here to this one on these, banks that are reporting that aren't the 100 largest, you can see the delinquency rates almost, 7.5%. So that is a huge uptick from where they're actually saying based on the health of the economy. So it's really important to look at when you see these numbers, you always have to ask, well, what is being reported and which institutions are they referring to? If these smaller financial institutions start to fall like dominoes, have to close their doors, they're going to be absorbed by the big banks, right? That just makes sense. That's what's happened in 2008 and in some of these other financial recessions that we've had. The bigger banks, financial institutions come in. So essentially, you're going to have a bank like Citigroup, BlackRock, of course, a financial money manager, and some of these banks that are too big to fail are going to become even larger. But as they assume the balance sheet of these smaller banks, those non-performing assets are going to end up on the bigger banks' balance sheets. At some point, it's got to have an impact, wouldn't you think? Let's go back to, let's go back here. Oh, it's like I've got you in this vortex. Okay, right here, I want to look at Citigroup in terms of their options because, so they're reporting Wednesday, and normally when a company reports their earnings and it seems like if it's going to be positive, that will reflect in the option price. Let me see if I can get a little more of this on my screen here. So that should be reflective in the option price. And what I'm seeing is that certainly isn't the case. Like so you have to go to the out of money options. Out of money options are in the white part of the option sheet there. The blue are what's called in the money options because the stock is already trading there. So we're looking at the out of money options, and I'm not seeing very much of a premium at all. Like for the 73s, they're at $1.05, and not a lot of open interest in these. So I'm thinking that the market isn't expecting a huge earnings release announcement from fourth quarter 2024, especially for Citigroup. As I look at these options, if the market was expecting, some blowout numbers and expecting the stock to go higher, these contracts would be so much richer. Like we'd probably be able to pick up the 76s for, $3 or $4 a contract, and they're only at 26 cents. So these contracts are revealing. They're showing, if you know how to read these kind of type of reports, they're showing that there's just not a lot of enthusiasm built up for this particular earnings report. But nevertheless, let's hope that the earnings are decent. The stock has certainly had a 1-year return. When we look at, here we go. Analysts expect earnings per share of $1.24, up 47.3% YOY, which means year over year. That is a big number. That's a big hurdle. In the last, right here, 1-year return for this stock, it's up 42%. Look at that, 42%. But as you go further out, 3 years and 5 years, it's just dismal. 5-year return is only 10%. So year to date, Citigroup is up 2.39. The S&P is down almost 1.5%. So it's showing a very strong beginning of the year. But I've seen this with other companies where they'll run the stock up, post lesser than expected earnings, and pull it back. So I certainly wouldn't be a buyer of Citigroup here. I'm simply a watcher of this industry because it's so important and really will reflect and set the tone for this earnings season. What else do I want to show you? Here's that positive yield curve that was mentioned. The 1-month yield is 4.30, 1 year 4.23, and then as you go further out on the curve, as represented by this blue line here, it slopes. It's sort of almost a flat yield curve, but nevertheless, it is a positive yield curve. Short-term rates lower than long-term rates, very healthy for the stock market. All right, last thing I want to show you, delinquency rate on consumer loans. All commercial banks, the delinquency rate has popped up considerably since 2022. We were at 1.54%. We are sitting at third quarter. These numbers are only since the third quarter of 2024. So the first half of 2024, an uptick of 2.73%. So we really need to keep an eye on that. If people tend to, if they're not able to pay on consumer loans, credit cards, things of that nature, it will become reflective in the data, and eventually it'll end up impacting the equity markets. And who knows what's going to happen with all of these disasters out there in terms of the wildfires and North Carolina, Tennessee area still dealing with the impact of these very unnatural storms. I mean, we're just going to have to see, how that holds up. Nevertheless, though, I just wanted to wish you all a great week. I think we're going to continue to have this volatility. I always say buy the dips, sell the rips. This isn't anything to be concerned about, but we will keep our eye on the bank's earnings this week, and I'll report back next Monday. So have a fantastic week. Thanks, everyone.